All right, so you're thinking to yourself, you know what? I bought a couple of homes. So why is it that my commercial lender is telling me that I need to get all my stuff together so I can refinance my commercial real estate that I just bought like a couple of years ago? If you'll stick around in the video, I'll tell you exactly why. All right. So in this video, what we'll do is we're going to discuss the key differences between residential and commercial lending. Now, we're not going to go into the super details of the mathematical formulas and all that stuff. We're going to reserve that for some later videos on this. But this is a smaller snippet out of a much larger video that I recorded a little over a year ago. And the material in it's really, really good, and I thought you should see it. All right. Now, if you look down in the description below, you're going to see links to that larger video. And then you'll also see links to the smaller snippets in there. I hope you like the video. If you do like the video, give us a thumbs up, please. And also hit that subscribe button and that bell notification so you can get more videos like this in the future. All right, enjoy. All right, so first, I get a lot of questions from people when they say, well, I don't understand why we're having to refinance this income-producing property. They all have homes and they have a mortgage. And they thought it would work very similar to a mortgage, and they didn't really understand the process. So what I thought I would do is spend a few minutes talking about the differences and what the process is. All right. If you have a home and you went out and you mortgaged your home, oftentimes people get a 15 or a 30-year mortgage. What happens with that is the bank that you go to get that mortgage, well, they don't have all that money with them. What they do is they go borrow that money either from a Fed or another participating bank or investors themselves. And what they'll do is they'll originate the loan. So they're going to all the origination process to create that loan. All right. There you'll get amortized according to the terms of the note. All right. Then eventually what they do is they go out and they take that loan that they've originated and they sell it on the secondary market. Now that may mean they still service the loan, but what they've done is they've gotten the loan off their books and they've sold it onto the secondary market. That loan that goes out on the secondary markets gets combined with thousands of other loans just like it. In fact, they call that a conforming note. And that's usually the only way they can really get it on the secondary market. And what they do is they take that and they put it in what they call the sausage grinder. And I'll show you that here in a second. But they package these loans together and then they sell them off to investors. Now, the nice thing about them is because they're sold in thousands, they understand the risk involved of a person who might, sell their home. They're going to move. They may default on their mortgage, and they may pay their mortgage off sooner, or they actually may die. And so the way they package these together, the risk isn't so great, and it makes the investment solvent for the investors. And we'll talk about that here in a little bit in a second. Let's go to our next one here. And this is kind of a graphic. It's not a really great graphic, but it kind of tells you what's going on. All right. So if you take a look down here, let me see if I can get a pointer going here. All right. I got our laser pointer. This is the bank, and it produces the loan for you. It also could be a hybrid bank, meaning it's a non-bank. And they can create a mortgage for you. It might be a mortgage broker who goes out and finds a bank that will mortgage your note for you. These individuals or banks will go out and they will borrow money from the Fed or other participating banks. And we just talked about that a second. When they originate that loan, they take it out onto the secondary market. And where you've got the normal Fannie Mae, Freddie Mac, there's all different kinds of federal agencies or quasi-governmental agencies that will sell it onto the secondary market. Well, what they do is they bundle all those loans together and they sell them into the private market. Now, they're backed up by a government entity, and that's what makes it solvent for the investor. All right. When we talked about the sausage grinder a minute ago, so all those thousands of loans go into the top of the sausage grinder, and they get ground up, and they go into what they call a tranching system. And what they do is each one of these tranching systems have a risk variable to it, and it's sold off to an investor according to that risk. And so this is what makes the process, and it's very complicated. I really don't want to spend a lot of time on it today. But what it does is this is what makes the whole process solvent. All right. The last tranche is usually called the Z tranche out of tradition, right? So now let's go take a look at the difference in a commercial system. Commercial is very similar. It also goes out and borrows from the bank, from the Fed or other participating banks. But here's where the difference is. It's hard to find conforming commercial loans. And so at any one particular point in time, there's not a whole lot of these loans floating around out there. And so they may package these together. And so they could decide when they originate a loan to whether to keep that loan in-house in the bank, or they may go out and sell it on the secondary market. Now, if they sell it on the secondary market, they don't have as many options on the secondary market like you do on the residential secondary market. And so they can only sell maybe 10, 100. It's very rare to go over that, but they're going to package them with other loans that are very similar in risk. And then, of course, they sell those, the intermediary that's in the secondary market sells those off to investors in tranche system, just like in the residential side. Now, the problem with this is because there's not a whole lot of these loans out there, they're subject to the risk of interest rates. So as interest rates change, it can really hurt this investment. And if you sell a loan, die, or something of that nature where you get out of that loan or prepay it, they may require you to have a maintenance fee in it in order to keep that investment going. Now, the way these loans are set up, they're amortized over the loan. So you may have a 15-year or a 30-year amortization on the note, but they're going to have a periodic refinance where they balloon that note. And it could be any number of years. It might be a year, it could be 3 years, 7 years, 10 years, 12 years. It just depends on how they set it up. And when we put together our pro formas, we account for that kind of thing. All right, here we go. Let's go to our next one. And again, that graphic's identical. The process is identical. The only thing you'll see different is the secondary market is not your normal quasi-governmental agencies, but they still look for government-backed agencies, maybe like the SBA. Okay? All right. Again, we have the sausage grinder, works the same exact way, except instead of having thousands of loans going into these, they may have 110, maybe 1,000. But they're packaged in such a way they're similar in risk. That way they can be broken out into these tranches. All right. Okay, so some of the key takeaways you should take from this video is that banks very rarely actually hold on to these notes. And while they may originate the note, what they're really doing is they're going out and borrowing money from other banks and then the Fed, and they're making that all work for themselves. So oftentimes they'll only hold on to it for a very short time. Their biggest risk, because commercial loans, remember, don't have that many loans in a conforming package, their biggest risk is interest rate risk. And so what they're afraid of doing is not being properly set up with their interest. So they want to reset these loans every couple of years in order to change the interest rates out. Well, I hope this was really helpful and informative to you. Again, if you go take a look at the description below, you'll see the link to a much larger video, along with the link to the much smaller videos that go with it, that are the subset of this bigger video. And also on the end card, I'm going to put some suggested videos up there for you to go see as well. All right, well, thanks again.